Hello, everybody, and welcome to another live reaction video.
Yes.
And we're almost just going to get right into it, get into what Powell said, and yeah,
We're back again.
we are back again. They
Yeah.
cannot keep us down.
If they keep having these meetings, we're going to keep reacting to them.
Exactly.
That's all I'll say.
Good afternoon.
Good afternoon.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low.
All right, we'll pause it right
Inflation
there.
has eased.
So you're going to start off with I guess they kind of have this dual mandate of like keeping unemployment low and inflation low. It's really what their mandate is. And so he says like the unemployment rate is low. So he is right. Okay. But if we'll go to the first slide here. But it's easy for that to happen when we're spending so much money.
Yeah.
It's really what's going on. And so if we use this first chart here, okay, so you have basically deficit on that up and down axis.
Yeah.
Okay. And then unemployment rate is on the bottom axis. Okay. So essentially, when you have a deficit this low, or like you have this much of a deficit, like it's a really high deficit.
Yeah.
Right. Essentially, it's really rare for unemployment to be like this at 4%.
Right.
So he is right that unemployment's super low, but it's essentially it's artificially low, right? Because if the government stops spending, then all of a
skyrocket.
Yeah, unemployment would be closer to where it actually should be.
Yeah.
And so, which is an unemployment rate way higher than 4%. And so, yeah, that's basically what's going on here. It's really easy to have this unemployment rate when you're spending.
Yeah. Can see right through it.
Yeah,
See right through
exactly.
what he's saying.
Exactly. If you go to the next slide, we'll just
Record government deficit.
Right, and then we'll show this is what we're looking at in terms of our federal debt on the public side, right? It just continues to accelerate, and it's not going to end. So essentially, yeah, they're doing great on unemployment. He's not lying. It's just that it's just artificial because of
the
spending. So we'll just keep going there and see what else Powell has to say.
Substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace.
Yeah, we'll pause it
GDP
here.
growth.
So basically, after this, he's honestly almost going to say nothing new.
Yeah.
So
He repeats himself a lot.
Yeah, so in this right, and so in this meeting, he's essentially just going to tell us that they have growth slowing, inflation's working their way towards the 2%. It's essentially everything that we have heard before. In this meeting, he's just kind of repeating it, which makes it a little bit not fun. But we'll skip to 4 minutes and 40 seconds, right? All we're skipping over is him talking about employment, which we just talked about,
Right.
and then on the inflation side, he's talking about is how they had a victory over inflation, which essentially they got inflation down on a rate of change basis,
Right.
towards 2%, and then he'll end it with, "We're doing it for the American people," which is always the really funny part.
That's very funny.
But when we skip to 440, just listen to what their decision here is. He's going to say that they're keeping interest rates lower and or flat, and they're lowering their balance sheet selling.
Yep.
Which all that means is essentially they've been selling securities in the open market.
Right.
And that makes that's a contractionary thing on prices because we're a forced seller every day. contracts. Exactly. Essentially, a forced seller lowers prices, but they're lowering that rate.
Yeah.
And when they're lowering that rate, it's actually kind of inflationary because it's all about the rate of change.
Right.
And so,
Yeah. Just to recap that, you're saying that as a forced seller, they're pumping the market with supply, just to simplify. So like the demand would go down. And that's what would kind of drop the price because
no, as a forced seller, no,
they're slowing the selling of their securities, which is going to be inflationary.
Yes.
Because prices will go up.
right.
Because there won't be the same supply as there was before. Sort of, like to simplify.
Yes, it's inflationary because there's less of this selling.
Yeah. Yeah.
On a rate of change
Yeah,
basis.
that makes sense.
And so, yeah, we'll go to 440 and start it right there.
For the American people.
Well, for
In
the
support of
American
these
people.
goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%.
Yeah, so we'll pause it
The
there. So, right, you're not going to lower the rate until they have evidence that inflation is going lower towards 2%.
Yeah.
That's a lie.
Yeah. Exactly.
Just so for everybody knows, inflation is currently at 3%.
Yeah.
Okay, and so they're saying until we have more evidence that it's going to 2%, we're
They're
not
holding rates steady.
Yeah, they're going to hold rates steady. But literally in about 1 minute, he's going to completely contradict that entire statement, and he basically just lied to you.
Yeah.
Which is kind of great. And so
It's classic. It's classic.
It really is. And so we'll keep playing here as he talks about balancing risks.
Second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks.
All right, so we'll pause it there. We'll just go, since basically he's lying to us, we're just going to go to the next slide and essentially just describe what happens in terms of what is the federal funds rate and what is the 2-year yield. So federal funds rate is the rate that the Fed decides, okay? And that's that blue line there. You can see like it's more stagnant, where on the other hand, the one that the market uses and more trades daily is the black line. Okay. And so what essentially happens is you'll see the black line front runs the blue line almost every single time. So when the black line goes up, and then finally the Fed will start to raise rates afterwards. All right, black line goes down, then the Fed starts to lower the rates. So basically, so let's look at what's happened to the 2-year yield in the last couple of months, because that's going to show us where the Fed is going to go next.
Yeah, and that's what people are referring to when they're saying that the market is pricing in a cut, is that they're looking at the 2-year yield and its direction.
Yeah.
And they can use that to determine like a prediction on number of cuts.
Exactly.
Yep.
Exactly. And so when we look here at from 4/30/2024 to 8/1/2024, you'll see the 2-year yield went from 5%, so 5.03, towards 4.27. So that's a deceleration of 76 basis points.
Very good.
That equals 3 rate cuts.
Yep.
Okay. So the market really doesn't care what Powell says, because it's all BS to begin with.
Yeah.
All that you need to know is the market has already priced in 3 rate cuts. That's what's going to happen. No matter what he says right now about how he has to wait till it goes to 2% to cut, it's already happened.
Yep. Yeah, that's it.
And so
That's what you look at.
Yep, that's what we look at to front run the Fed, and that's what he's about to do. And we'll skip all the way over to 7 minutes and 13 seconds here.
Let's go.
Oh, okay. So pause. Watch as he. So on this question, by the way, it's really funny. Watch how he just gonna talk off of a piece of paper. So if you needed to know whether or not these questions are real, I can guarantee you this first question he knew it was coming.
Planted.
Right. So he's talking about not cutting rates, and I watch it as the first question is about cutting rates. It's kind of hilarious. So yeah, I would say
Gina Smilek from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
So he's already talking about.
So you asked why not today, and I would just say again that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
You can pause it here. Yeah, it's like hiding. It's hiding behind jargon. It's like, let me do this manuscript for a couple, almost 7 minutes, put everybody to sleep, and then we'll actually answer some questions and say something. Which why couldn't he just put what he's reading off of on a piece of paper into that first part?
Yeah, I don't know. It's the exact same thing I feel like he said last time. It's the whole opening statement. It's just
and that's why we skipped the entire thing.
It doesn't matter.
It's boring. It doesn't matter, and so forth.
Yeah.
But yeah, funny that he's just reading off the script. And we'll go to the next. We'll just keep it going to this last question on the 2 follow-up, because every question you can play it. Because every question is going to be about rate cuts.
Yeah.
Literally every single one.
Yeah, well, it's coming up,
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut, and maybe that it wouldn't be appropriate to cut. So if we were to see for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier, and we were to see higher readings from inflation, disappointing readings.
Yeah, it's just like garbage. It's like, yeah, dude. Everybody knows that, but
well,
it's just like a meaningless meeting.
Yeah,
These meetings are. That's the kind of the point of our whole thing is he's just saying whatever.
Well, it's also the point is to pick through all this to give people the actual understanding of what's actually going on in the economy.
Right, because he's not going to tell you.
He's not going to tell you what's going on. But I also find it funny because he's as long as things remain reasonably strong, or as long as everything stays in line with estimates. So. It's really pointless. So I'll tell you where the estimates are and where this is all going. It's just essentially this small deceleration in growth, so GDP. So when you have a small deceleration, you'll see things like tech earnings also go down.
Right.
Earnings throughout the market also go down as GDP goes down.
Right.
Kind of a
quad 4.
Yeah, we call it quad 4.
Anyways, besides the point.
Right, it's just deceleration. That's exactly what we have too.
Yeah.
But we don't have this imminent recession or anything. To get that out of the table. No, there's no imminent recession. Things going to zero. We don't have that.
No.
More it's just a slow meandering deceleration, and then in line with estimates, it's basically he's as long as everybody else believes it's going to go down slowly, we're still going to cut.
Yeah.
And so what happens?
And everybody wants a cut.
Everybody wants a cut. Why does everybody want a cut? They want the price of things to go back up because that's how they get paid. Is when things continue to go up. So that's basically what it is.
Yeah.
And so if we'll go to our next slide here to more to give everybody exactly what's going to happen from meeting to meeting, because this will be way more important than anything else you hear. So July meeting. So on the right hand side, you see that it says July 30th. So that just happened.
Yeah.
All right. September 17th. That's going to be his next meeting. Okay. And the market is estimating one rate cut, so a 25 basis point rate cut there.
Yeah.
But the important thing is, though, is what last 3 inflation reports that he will have in his hands going into that rate cut. And so he's going to have a CPI that says 3.0, small acceleration from that, so like a 3.1, 3.2 maybe.
Yeah.
Basically a flat reading,
Basically the same thing.
nothing wild at all. Then after that, the last one is going to be a deceleration. So
Yeah.
maybe it might even have a 2 in front of it.
Right.
That'll get the whole market going. Like that's going to be great. So right, we really do believe here at Hedgeye that they'll get that first rate cut in September. And it might even be a 50 basis point rate cut. We have to see as we get closer. That's what we're expecting.
Right.
Then we go to November. And so what are the 3 inflation reports that they'll have then is that deceleration, so that might have a 2 in front of it, another decelerating CPI print, and then a flat report.
Yeah.
So no acceleration, so that's good, right? So they might get another rate cut, right?
Yeah.
Which also just means price of things may start to go up.
Right. And
then the problem is once they get to this December meeting, that's where like the fun police starts to come in, and it kind of stops.
yeah.
And so
it
they'll have
exposes what is going on, where he's just doing it in order to juice things, and it's gonna all come crashing down on him.
well, no, it's that inflation will reaccelerate.
Right, but that's just bad for everybody. Like
Yes.
yeah,
Yeah, exactly. Like you'll have this small reprieve or reprieve. What's the right word there? Reprieve. We'll have this small reprieve, right? Where inflation is coming down, and growth is also coming down slowly, right? But then you get this boomerang effect after that, where the last 3 reports that we'll have going to that December meeting is a flat report, and what we believe are going to be pretty large accelerations back to back, decently large.
in inflation, yeah.
And so inflation is going to reaccelerate on him, most likely in the back half of the year.
Yeah.
And so that's essentially what's probably going to happen. So the market will get their 2 rate cuts, and the market likes rate cuts because they get paid off of them.
Yep.
And so that'll be good.
So what's your outlook on if this plays out exactly like this? Is it a failure by Powell? Is it like what would you say about it?
It's more.
Is it him being incompetent? Is it just like him pandering to Wall Street to give him rate cuts when they don't really deserve it?
I think it's more that they don't do macro like us.
Right,
They don't
understand.
They really don't understand. I think they really believe in what they do.
Yeah.
And because they believe it like that, like to them it's right.
Right. Yeah.
And so this rate cut kind of makes sense because inflation is going down and so is growth.
Right.
And so what they do is they cut so that growth doesn't go down as much, right? Because they're supposed to keep the market up, right? And so they're going to succeed in doing that.
Yeah.
But the overall problem is that if we get into the back half of like the early 2025, and all of a sudden you have an inflation prints with 4%, 4.25%, or maybe just like 3.6%, like
even that's high.
It's going to be that. Yeah, that would be some
even more pressure than now.
It would be more pressure than now, and then all of a sudden you have to start actually raising rates.
Yeah.
And then that's going to put a real hard push on almost the entire economy.
Yeah.
The economy can barely handle where the rates are now. Imagine if it goes up even further.
No.
So I think at the end of the day it'll be a mistake, and I think really at the end of the day it's going to be the biggest mistake because our government's going to keep printing, and that's overall going to.
They're going to try to save everything by just printing money.
Yeah, and then that's
like their fallback.
And then that's going to be more inflationary, and then you have to have rates go up even further. So it's just hopefully
that doesn't happen.
Hopefully that doesn't happen. But we'll go to something way more interesting on the next slide. So I wanted to show just why CPI and this whole measure for CPI is kind of silly. Okay, so here on this slide, you can
As in the Fed using CPI to measure.
yeah, more for the people to understand that the CPI, like CPI up 2%, like, and you know how people say, oh, your wages should go up 2% with that. So like, really, what I'm trying to show here is that like that you're really undercutting yourself.
Yeah.
Really, what you want is there's something called M2, and that's the overall money supply.
Yeah.
And you really more want to keep your worth and your wealth close to that instead of the CPI. Because so here's it's going back to 1971. What 1971 is when gold was taken off of the dollar was no longer backed by gold. So you that's where you start. Okay, so you look at CPI. That's that black line. Okay, you can see the black line and how much it's accelerated until today. Right, it's like nothing. Right.
Right.
So.
But
The real line is that blue line. That's M2. That's more what you want to keep pace with is the overall money supply. And so how do you keep pace with that? You have to look at nominal net worth. So what people's net worths are.
Yeah.
That keeps pace. Why is that keeping pace? Because your net worth, these people's net worth is in stuff like the S&P 500 and gold.
Yeah.
And by the way, that's S&P 500 with no dividends because my Bloomberg was not working for some reason. But if you had dividends, S&P 500 is eons above gold, just so you know.
Yeah.
And so that's really the message here is, they're all focused on CPI, but like don't fall into
such
that.
A small effect compared to.
Yeah, like that's not the real inflation in the economy. The real inflation in the economy is much closer to that M2.
Yeah. Okay.
And so if we go to the next chart, if we go to here's how this is adding in the NASDAQ. We go to 1987 because that's when I have home price data and the NASDAQ data. You'll see that's how much that NASDAQ outperforms all of these. Unbelievable. And then you go to the next chart. I took out the NASDAQ because it makes it hard to see.
Yeah.
And I added in home prices, right? So everybody says you have to have a home, right? So
and that's why you should have equity. Yeah, you need to buy a house so you can have equity.
Yeah.
Blah, blah, blah.
And so the funny thing about that chart is you can see that the home prices versus the S&P 500 and versus gold and versus the M2.
Yeah.
So I don't know if this makes sense, but like overall, you can like really kind of see like if you're keeping pace with the actual CPI, you're actually losing out because everybody else is winning.
Yeah.
Because they're above actual M2.
Yeah, that makes sense. Interesting. Yeah, I'm sure a lot of people don't know that.
Yeah.
It's cool.
Any questions on that one? Or?
No, I mean, to be honest, I think this meeting was really just kind of a placeholder for September. Everybody's looking ahead to September. People knew he was going to be somewhat dovish, I guess, in his language. And,
Yeah.
we'll have to see. I feel like a September 25 basis point rate cut's kind of a lock.
Yep. Market agrees with you.
At Hedgeye, the point of this is to just show that you don't have to listen and be angry about what they're doing. You can make money off of their shortcomings, right? Like if they had a measuring and mapping process like us, they would know all of this, but clearly they don't. And so that kind of gives people an edge if they do understand.
Right, we're here to front run the Fed, right? We
Fed.
already told you what they're going to say in the next 3 meetings,
Exactly.
where the Fed doesn't know what they're going to say tomorrow.
Yeah, literally.
Right, and so,
as he repeatedly says, he's like, we don't even discuss September. Like, I find that hard to believe, but sure, if you say that, that's even more concerning.
Yes.
Come on, you don't have a plan?
Yeah, pretty much.
What are you talking about?
What you talking about, Wills?
Yeah. So I mean,
We'll see what happens as we get closer to that September meeting. We'll probably put out updates if it's 25 or 50 basis points, but we'll just keep watching the data and let us know what he's going to do.
Yeah.
But
stay tuned.
Yeah, stay tuned
for more.
All right. Thank you, everybody.